Um, Welcome to the October edition of FX Periscope. So, for those of us who are joining us for the first time, I'm not sure if they are because there will be a couple of people who will be joining. FX Periscope is your monthly guide to navigating India's economic landscape and currency markets. It's brought to you by First Basis and QuantEco Research. This collaborative effort offers in-depth analysis of Indian economic fundamentals, expert technical views on currencies and interest rates, and actionable insights for informed decision making. So stay ahead of market uncertainties and optimize your risk management strategy with FX Periscope, driving business growth and success. So I'd like to quickly introduce the two authors of the monthly report, Mr. Vivek Kumar, who holds a master's degree in economics from Delhi School of Economics and brings close to 18 years of rich industry experience in the field of macroeconomic research with focus on financial markets, especially currency, fixed income, and money market. He has extensive experience in engaging in with clients, treasury, foreign investors, regulators, trade associations, and multilateral bodies over the coverage of economic and market outlook for India. So over the last decade, Mr. Vivek has also been addressing key industry associations via various outreach programs. His views on Indian economy are widely covered in the media, including financial media houses, and he regularly writes incisive columns in marquee media publications. So his views are keenly followed by treasury teams in corporates and banks. Uh, Mr. Vivek previously worked as president and senior economist at Yes Bank, and his earliest stints include the role of treasury economist at ICICI Bank and research associate at Progeon. Alongside Mr. Vivek Kumar, we have Mr. Yashwant Rao. Mr. Yashwant Rao is an independent authority on currencies and commodities price risk management with a background that includes positions such as head of strategies for commodity price risk management at Reliance Industries. He brings a wealth of experience to the table. He has also served as a forex consultant to corporates at Patterson and Co. FX broker, and currently he serves as an expert consultant for commodities and forex at First Basis, offering valuable insights and expertise. I think we can start. So over to you, Vivek sir.
Thank you, Sumant, and good evening, everyone. Give me 30 seconds so that I can share my screen, and I have a couple of slides. Then the discussion will be much more meaningful. Just give me 30 seconds. Is that visible? Great. So I'm going to start now. This, I think, is the third in the series, Sumant, if I'm not wrong, the FX Periscope
Yes, sir.
webinar. Okay,
This is
great.
the third edition.
Third one. Okay. So in this particular monthly series, we're going to talk about the different pulls and pressures which are currently acting upon rupee from the macro fundamental side, and then Mr. Yashwant Rao obviously is going to supplement this with what his charts are telling us at this point in time. So let's straight away dive in and see what's happening in the global economic environment as well as what's relevant for us from an FX market perspective. Now, there are two different themes which are currently dominating the overall narrative. One is the fact that we talked about this in our last webinar, that while there is a concern on global growth, that concern is not uniform. That concern is largely on the manufacturing space, whereas the services space is still doing well. Now, where exactly is this concern on manufacturing stemming from? So we decided to go back and did some simple correlation analysis and looked at some of the variables which could possibly explain this. And what, to a surprise, I mean, not I would say, greatly surprising, but to some extent, it's kind of revealing that the increase in global trade uncertainty has kind of coincided with the weakness in manufacturing sentiment. And as you can see, the global PMI manufacturing, while India is still doing much better than what the global manufacturing sentiment is currently telling you. But nevertheless, since we're talking about the global environment, it probably makes sense to look at it. And you can see how the manufacturing sentiment has turned around exactly since the time the uncertainty on global trade, especially with respect to US, has picked up. So the picking up of US trade uncertainty has coincided with souring of sentiment on the manufacturing space globally. Nothing to do with India, but this is what is happening globally. And this is one thing which we thought was worth talking about. The other important development in the last few months, last 2 or 3 months, has been the competition among various policymakers in trying to support their respective economies. And this has come about in the form of various policy easing measures. Starting with, while US did their own big bang policy easing in the month of September, largely on the monetary side, nothing much on the fiscal side. But there are other countries which have either started already, they are much ahead in terms of US, or they have now joined the US Federal Reserve in trying to support their economy. So China is an important case here, because the Chinese government as well as the Chinese central bank, the PBOC, both have now come together and now started to take steps to support the economy. And China is important because it has twofold implications. So any form of policy easing has twofold implication. One is the fact that with Chinese government or Chinese central bank trying to support their economy, the earlier narrative that China is slowing down and it will also bring down commodity prices will no longer hold. So then, to some extent, it is going to provide support to global commodity prices. That is one takeaway from Chinese policy easing. The other takeaway from Chinese policy easing is the fact that with a lot of negative sentiment built around Chinese economy, especially in the last 6 or 8 months, the sudden turnaround in terms of policy support is now resulting in portfolio rebalancing across global portfolio investors. So global portfolio investors were actually taking out money from China for a major part of the year. And India was an important beneficiary of this when this was playing around. Now, when the reverse has started to happen, when there is now increasing amount of optimism with respect to Chinese economy not meeting such a bad fate, then this rebalancing at a global portfolio level, especially on the equities front, has started to cause some bit of rotation, some bit of churn in global portfolio flows. And what we are seeing in case of India is we will definitely talk about it, not just India, across emerging market space. There is money is getting pulled out from some of the emerging market countries, and they are getting redirected towards China. So it's a portfolio reallocation, a churn in the global portfolio sentiment, which is happening with Chinese policy authorities have kind of engineered. So these are the two clear narratives which are
तुम्हाला
shaping
फरक नाही पडणार
the FX
मला
market
का
sentiment at this point in time.
मी
May I
लावून
please request
मी व्हिडिओ
somebody's
लावून
mic
मला
is
ऐकायचं बोलायचं नाही
on unmute. If you can mute it, it will be good for everybody here. Thank you so much. Now, commodities is an important aspect for India's current account balance as well as the currency, because we are a net importing country and we need to pay a lot of attention, in fact, close attention to some of the commodity prices. And here, what we see is two things. One is that commodity prices, despite the fact that the recent policy stimulus in China is providing them some bit of support, the commodity prices are still in a zone of caution. The copper gold price ratio, which is a traditionally an important indicator to look at with respect to where the global economic cycle is going, is currently in a softer territory. The most of the common or the generic commodity price indices, whether it is energy, whether it is industrial metals, or whether it is agriculture price index, I think most of them are still not giving you the indication that, despite the policy support that we are seeing in some of these economies, there is a runaway price movement. barring maybe precious metals, which are currently seeing a different set of drivers altogether. But energy prices are down, agri prices are down. So we are talking about the annualized changes here. Industrial metals, last 1 month, they have seen some bit of run up. But again, it's something which is not extremely perturbing at this point in time. For India, I think what is most important is crude oil. And crude oil so far is at 77, 70, 76, 78 range. That's the range which has been there for the last 6 to 8 weeks. And this is I would say, pretty much a sweet spot for India, because last financial year for us, the average price of crude was $82 to a barrel. So as long as it stays under that, I think India is going to do fine from a macroeconomic perspective. Now, trade is where there is going to be a lot of uncertainty, not just in 24, but more importantly, 2025. Because what's happening in case of US from the run up to the presidential election campaign, I guess there is a lot of policy focus. It can just be rhetoric. We don't know yet. But as far as the initial vibes are concerned, it is posing a lot of concern on the trade front. And while it has nothing to do with the trade which is currently ongoing in the year 2024, but 25 onward, this is going to be an important source of uncertainty in the market. Having said so, even in the near term, I think there is a little bit of caution. So if you look at what's happening in the Mediterranean region or the Red Sea route region, which is currently afflicted by the Middle East tensions, the uh, the trade volumes have started to come off. So while all of us know that the crisis started in the Red Sea way back in December of 23, and it's been 9 long months since then. So there was rerouting of ships from the Suez Canal route to the Cape of Good Hope, and everything was looking as if it was progressing well, because what one route lost, the other route gained. And in some sense, barring maybe a delay of 2 to 3 weeks, it appeared as if nothing was getting impacted on the global trade front. But now it looks like there is a softening, especially in the last 2 months when the tensions have really escalated. And as you can see, the Cape of Good Hope is now losing in terms of the trade volume. It peaked almost 2 months ago, and now the volumes are dropping. Whereas at the same time, the Bab el Mandeb Strait, which is your entry point, the choke point to your Suez Canal route, is flatlining, or in fact continuing to decline. So if you take the cumulative trade volumes passing through both these trade routes, you are actually seeing a decline. And this decline has been happening for 2 months now. So it's something which is on our active radar. We track this data on a weekly basis. And so far, it is not giving us any encouraging signs, even from a 2024 perspective. So we're not even considering what will happen in 25. Let's say if Trump were to come back to power, even if Trump doesn't come back to power, I think the current regime itself is not going to be very trade friendly. So it's a choice between something which is not going to be friendly versus something which is going to be completely against. So it's not going to be a very pleasant choice from a 2025 perspective. Last but not the least, even on the price front, the cost of moving containers across continents, across countries, has been extremely elevated. On a year-on-year basis, the container costs are running a price hike of more than 200% for the last 6 months. So that's the average price increase for your container costs in the last 6 months. So the moot point here is that you have uncertainty on your trade activity. You have a significant amount of price discomfort on the trade front. And put all together, then you're looking at a global trade environment which is going to be extremely, extremely uncertain, both in the near term as well as in the medium term. So with this backdrop, the rupee continues to depreciate. It's not a surprise at all for us. For long-time readers of First Basis and QuantEco report, uh, they would definitely not be surprised by the depreciation in rupee, which is kind of continuing at a slow pace. And we've been arguing this for quite some time, that despite the anticipation of dollar strength, dollar weakness in 24 as well as in 25, despite the turnaround in sentiment with respect to monetary policy easing, rupee depreciation will possibly continue. And although we were kind of maintaining that view, we also said that the rupee depreciation is going to be slow and gradual. And this is a new phase of rupee depreciation, which is not going to be the same as the previous phases of rupee depreciation. The previous phases of rupee depreciation were marked by extreme amount of volatility. This time around, that is going to be completely absent. So we are in a new regime where while rupee depreciation might progress, it is going to progress at a pace where volatility is going to be extremely subdued. So we'll discuss why this is likely to be the case. Now, when we talk about the pulls and the pressure, so this is one of the pull factors for rupee, which kind of supports it from a macro angle. One is the growth part, and second one is the structural improvement in its current account deficit composition. Now, growth, we all know that, if I have to compare India with how it grew in the last financial year and what are the growth prospects for India in FY24, maybe going FY25 and maybe going further in FY26, then one would probably get a view that growth is slowing down. We kind of peaked at 8.2% last financial year in terms of GDP growth. Our own forecast for the current financial year in terms of GDP growth is 7%. If one has to take a long-term view between now and the next 5 years, the number that probably one would settle around would be anything close to 6.5% to 7% range. The IMF itself forecasts India's GDP growth for the next 5 years at a rate of 6.7%. So it's pretty much in that 6.5-7% range over the course of next 5 to 6 years. And while it's a deceleration from FY24 levels, but nevertheless, it's a decent amount of run rate. It's a decent momentum. And not many countries in the world are able to depict that kind of growth on a sustained basis. So we did a cross-country analysis, and what we found was India's percentile rank in terms of its growth momentum over the course of next 5 years is expected to be at 95%. In fact, and this percentile rank on a 5-year rolling moving average basis is the best that India has seen since last 4 decades, in fact. So that's the kind of growth support that one is looking at. And this clearly differentiates India from being one of the best performing large economies in the world. And probably this will continue to act as an important source of capital pull. So this is one area where you see the pull factor working in case of the currency. The other area where the pull factor is working in case of the currency is the change in composition of its current account deficit. So India had an extreme amount of dominance on the merchandise front in terms of its trade deficit, and that used to dictate what is going to be the magnitude of the current account deficit. Now, in the post-COVID phase, especially in the last 2 to 3 years, there has been a perceptible degree of increase in its services trade balance. And the services trade balance now funds a little over 2/3 of the merchandise deficit on trade. And this is an important change because it tells you that this is something which has not happened just because commodity prices have softened or maybe merchandise trade has softened. It is telling you that it has happened because services have picked up structurally. And it's not just IT driven. It's in fact no longer just IT driven. There is a lot of new age services which have come up in the area of business process outsourcing, in the area of management outsourcing. There are various other fields which are also now taking up. There are data centers which are coming up in India almost at a breakneck speed. And India outside the US is now the largest country to have data centers located across the globe. So these are developments which have happened in the last 3 years, and these are changing the composition of your current account balance. So probably, it would take a lot for India to now go above 2% current account deficit. In fact, 2.5% current account deficit, which we used to see pretty frequently earlier, will now take a lot of effort now because something will have to go drastically wrong in the current global environment for India to now post a 2.5% current account deficit. There has to be an extreme amount of commodity price shock, or maybe there has to be an extreme amount of increase in domestic growth momentum in a very short period of time, which will do it. Otherwise, in a business as usual scenario, I think it is safe to now assume that India's current account balance is going to be under 2% of GDP for a fairly long period of time. So this is something which is a positive development and encouraging development from an FX perspective. For FY25, we expect current account gap to be at 1.2 percentage points of GDP, still lower than, marginally higher than last year's 0.7%, but still lower than its long-term trend of 1.3, 1.4%. So it's still going to undershoot its long-term trend. Now, we talked about the pulls, and now it's time, I think we should also start looking at the pressures here. This is one area, valuation is one area which we kind of discussed last month, and it continues to be a factor which weighs on the currency. Rupee is over 7% overvalued as we speak today. And last month, in the month of July, it was more than 9% overvalued, where it had crossed the typical threshold where you see reversals in the currency. And in last month, we had said that whenever those breaches happen, rupee tends to depreciate by anywhere between 1.5 to 3 percentage points with a lag of 6 to 9 months. So this was one of the basic premise why we were calling for continued depreciation in the currency, just to make sure that further buildup of overvaluation does not seep in, or maybe use this opportunity as to correct the extent of overvaluation to the extent possible. Now that's a structural factor which is weighing upon rupee, but there are also a few cyclical factors which have now come up, especially in the last 2 months. And India's inflation differential has once again moved against it. So typically, when you think about inflation differential from a currency perspective, you typically compare India's CPI inflation with US CPI inflation. Although the central banks in both these countries, they do not target the same inflation variable. While we target CPI inflation, their US Fed targets core PCE inflation. But nevertheless, to make things comparable on an even footing, we are taking CPI inflation from US. And typically 2% is the threshold, or 2% ideally is the implied differential from a target perspective. So US targets 2% inflation, India targets 4% inflation. The differential is 2%. 4 minus 2 is 2%. So in the long run, the India-US inflation differential should stabilize around 2%. That is what the objective should be. And in the current phase, after dipping in the recent months, the inflation differential has once again risen against India, because in last 1 month, our inflation has gone up because of food price pressures, while US inflation continues to move lower. Although one can argue that US inflation is not moving as lower as market participants expect it to, but nevertheless, in terms of direction, US inflation is still moving south, whereas India's inflation has shown a spike upwards. So that has caused a near-term a disruption in terms of the inflation differential. And when we talked about the Chinese policy stimulus, both from the government side as well as from the PBOC side, and when we talked about the churn in the global portfolio sentiment, we notice it here that in the month of October, so far, this is, I think, this does not include today's data, but $8.1 billion outflow just from the equities, Indian equities have happened in the month of October so far. This is the second largest outflow from Indian equity market on record. The largest outflow happened during COVID. This was as soon as COVID became the global pandemic, as announced by the WHO in the month of March 2020. $8.3 billion flew from our domestic equity markets. So we are kind of approaching that level in dollar terms. And it remains to be seen whether this is going to be a knee-jerk reaction, whether things are going to stabilize after October or not. Our sense is that this is a knee-jerk reaction, because typically whenever you see a change in some of the important economic or financial variables, the immediate month after that change tends to bear that brunt. So it happened in the case of COVID, $8.3 billion went out, but then it's not that 8.3, or in fact the subsequent month continue to see outflows. So it will probably be, the impact is going to be concentrated in that particular month. And just to remind you that it's not just Chinese policy stimulus which is causing this nervousness in global portfolio sentiment. It's also the geopolitical upheaval, the geopolitical disruptions, which have come about unfortunately at the same time, which is causing this I would say nervousness in equity market. And it doesn't help when your domestic equities are overvalued. It doesn't help when your currency is overvalued. So when your assets are overvalued, it is ripe for correction. And whenever such an opportunity comes your way, the global portfolio investors are going to book their profits and maybe put it in undervalued assets. So Chinese assets would probably appear undervalued compared to India at this point in time. So there can be a near-term churn, and this churn again is largely on the equities front. The debt side has not been impacted. The debt side has not been impacted because of India's inclusion in the global bond indices. So while you've not seen a heavy amount of inflows in the month of October, but at the same time you've not seen outflows from debt in the month of October so far. So it's largely equity related. Now, how does this boil down to in terms of RBI's ability to do what it has been doing? Well, we think that RBI has done a splendid job in amassing reserves whenever they got the opportunity to do so. Currently, we are sitting at almost 615 odd billion dollars of foreign currency assets, and that's a record high. So the actual FX reserve number is more than $700 billion. That includes gold and other assets. But in terms of just foreign currency assets, we are at 615 odd billion dollars. That again is a record high number. Uh, so that improves our firepower, no doubt. It makes good headline, but at the same time, we have to be cognizant of the fact that our real holding of FX reserves have not really gone up much. So we are still close to 10 and a half months of import cover, and we need to do possibly even better than this. So something close to 12, 13, 14 would be much more desirable than what it is right now. It's a good number, no doubt. I'm not casting any doubt on this number. What I'm just saying is, given the escalation in global economic, political, as well as trade uncertainty, now, these are escalations in uncertainty which have not happened in the last 2 decades. So to compare how things were in the last 2 decades with respect to what it is right now, and to compare our reserve adequacy with respect to how it was last 2 decades, I think it would be slightly unfair, and we'll have to fine tune our reserve requirement vis-a-vis what's happening globally. And since globally things have become much more uncertain, I think it would make sense to buy more insurance or to collect as much insurance as possible. So we would expect RBI to continue to amass reserve, continue to buy dollars whenever there is an opportunity. They will get that opportunity in this year. They will continue to get it because our forecast for balance of payment surplus is anywhere close to $50 billion. So which means through the course of the year, RBI will definitely get enough opportunities to build reserves. Now, in the very short term, when we are seeing some amount of pressure on the currency, I think it makes sense for the central bank to let the currency depreciate. Also, because we talked about the overhang of overvaluation, and that needs to be corrected. While even if you don't want to correct it, I think it makes sense to not let further overvaluation creep in. So if, let's say, RBI completely stands in the way of depreciation, and if other currencies depreciate, then the extent of overvaluation in rupee is only going to increase. So you would not want to do that. You would either want the currency to kind of adjust according to what the broader trend is. And last but not the least, I think the added advantage of doing it is that you would be passing on more revenue to the government of India in the form of dividends, because when RBI does two-way intervention through the course of the year, it generates extra revenue in the form of FX income, which is at the end of the year passed on to the government of India as dividend. So it makes sense to do what RBI is currently doing right now. Try and manage rupee from both sides, and use opportunity strategically to also generate revenue for the government. Last but not the least, our outlook. We continue to maintain our view that 84 half is where rupee should find its level this year. In fact, before the end of the year, it is quite a bit of a possibility. In fact, what we've observed is the fact that market
Their own
expectations,
projection is only the same, 84.5 by March end.
the market expectations have gone up in terms of USD INR. Almost 9 months back, the markets were expecting a slightly much more constructive view on rupee. They were looking at close to, I think, 82.7, 82.8 was the level which markets were expecting 9 months back. Now the market expectation is moving close to 83.8 levels. So there has been a one big figure change in market consensus expectation for the FY25 year-end value for rupee. We, in the meanwhile, have remained completely unchanged over the last 9 months in terms of our call on dollar rupee. And if at this point, if you have to take a gun and point it at my head and say which way would the risk lie, would the risk lie towards lower end in terms of meeting the market expectations, or would the risk lie towards further depreciation in rupee? I think the risk would lie that rupee depreciates even further than 84 half, than moving closer to 84, which probably is what the market is telling us right now. But nevertheless, we are not going to talk about that because the baseline is still 84 half. There are enough pulls for rupee from a domestic macroeconomic stability perspective. And currently, even as far as the monetary policy expectation for the US Federal Reserve is concerned, we've seen enough volatility. Just about a month back, exactly 18th of September, when the Fed announced its policy review, the markets were expecting 250 basis points of rate cut. So this was sorry, 150 basis, yes, 250 basis points of rate cut by the end of calendar year 2026. And what the Fed was saying was, the Federal Reserve was saying that they would deliver 250 basis point rate cut by the end of 26. Markets were expecting it to take place before the end of 25. So markets were fairly aggressive. They were front loading every rate cut expectation just about a month back. And as the situation stands today, as you can see on the chart on the right hand side, the indigo bar is now completely fair in terms of its probability distribution as to whether the interest rates are going to be aligned with what the Fed has said. So almost 1/3 possibility each. Now the markets are attaching 1/3 probability to Federal Reserve policy rate being the same as the Fed dot plot indicated in September. 1/3 possibility that it would be lower, and 1/3 possibility that it could actually be higher than what the Fed is saying right now. So now it's on a very even pedestal. All those excesses have now evaporated from market expectation, and now it appears that it's a fair pricing. So given this kind of an environment, I think we would still stick to the 84 half view. But nevertheless, the risks definitely lie on the depreciation side rather than on the appreciation side, especially on account of what is happening to trade. Because I think right now, so we did take a look at the WTO recent trade outlook projections for 24 as well as 25. And they kind of still appear optimistic. So what the WTO did was they revised up their global trade forecast for 24 by 10 basis points. They are now saying the global trade volumes are going to grow at 2.7% vis-a-vis 2.6% vis-a-vis the 2.6% estimate that they gave 6 months back. For 25, they are saying that the global trade volume is going to grow at 3%. This is a downgrade from 3.3%. So it's a 30 basis point downgrade. But nevertheless, if you compare 24 and 25, what WTO is essentially saying is that global trade is going to increase in 25 vis-a-vis 24. I think that appears slightly optimistic because of what's happening on the global geopolitical front, especially with respect to the Middle East tension, as well as, more importantly, the US presidential election. So whosoever gets to become the president, I think the policies will start to change from January onwards, and 25 is where the real test for global trade is going to lie. We know that it is extremely difficult to model whatever is going to happen, but in terms of the gut feeling that you have with respect to which way which direction the risks are going to lie, then I think this is probably I think the easier way out to say that the risks are going to lie on the depreciation side because of what's happening at the global level. So that brings us to the end of our view. Again, 84 half, just to wrap up. And with this, I invite Mr. Yashwant Rao to take you through what he has up his sleeve in terms of his technical charts. And I would also take this opportunity to learn what he has to share. So over to
Vivek
you,
sir,
Mr. Rao.
just before we hand it over to Rao sir, there's a
Yes, Shubham.
question from Ram Narayananji
Yes.
in the chat. Let me just read it out loud. Vivek, will the Chinese stimulus boost the Chinese economy? The signals from consumer spending from the Golden Week holidays have been lackluster. Signals from the last Saturday announcement too have been mixed. Is this stimulus a flash in the pan?
So there is some degree of, let's say, dissatisfaction at, around that with respect to, because there was a lot of anticipation when this was about to be done, and I think if you look at how the equities have reacted in China, so they shot up initially, and now after that there has been some level of correction in the equity space as well. So definitely there is some bit of dissatisfaction because the numbers do not tie up at all. In fact, some of the fiscal aspects that the government has told with respect to debt restructuring or with respect to the real estate sector does not really provide you that comfort that this is going to be a big bang fiscal stimulus coming from the government side. But the government is still a little bit concerned, a little bit cagey about their debt levels, and which is fine from a macro prudential perspective, because you, on one hand, the Chinese central bank is easing. On the other hand, if you want the government also to go berserk, then you would end up being in a situation where you will have to go back to again the rescue part again, because China, for all that is worth, China is coming out of a debt binge, and that created a lot of problem in the over the last decade or so. So in terms of trying to pump prime the economy again via that route, the central bank, the government is probably taking a little bit of a cautious approach. So it is possible that, which is also reflected in the market sentiment, that after the initial euphoria, there has been some correction. But nevertheless, I think from uh, an investor perspective, vis-a-vis what how sentiment was maybe 2 or 3 months back, when left, right, and center people were marking down Chinese growth, investors were pretty comfortable selling Chinese assets. At least that sentiment has now reversed. So that when people were writing down China completely, both in terms of economy as well as financial market, at least that sentiment is now getting questioned, and there is definitely some bit of fresh allocation towards China. So it might not be as much as maybe some of the aggressive investors might have anticipated, but nevertheless, it is better than what it was 2 months back.
Thank you so much, sir. I think, Vishwanath, sir, we can start your session. Over to you, sir.
Okay. Thank you, Vivek. Very nice explanation. Mine is just based on technical, not as many details as Vivek has given, but they are more helpful to a trader or a hedger. To begin with, I'll just show what is the forecast for the year. This was given in December 23. There at that time I was so bullish, I was anticipating 86.25. It was based on 6 months and 2 months, 3 months bar. That is, each price bar will appear after 6 months or after 3 months. That is 4 bars or just 2 bars per year. Based on that, so this may be a bit wide off the mark in the present context. Just to keep the perspective. So at the back of the mind, the picture is bullish for 86.25. Now we will go to the more recent for the near future. What would be the? I'll give a brief presentation on the. This is, see, this periscope is a publication which comes out every month. That is, for the month of October, I would have prepared it, not I would have, I had prepared it on the 1st of October or maybe 2nd of October, which was the holiday. So Vivek also does the same thing. Whatever he has given is not based on today. He must have based it on as on the 30th of September. On that day, whatever condition prevailed, based on that, he has given his commentary on the FX Periscope. So I'm going to take from the commentary which I have given in October 2024, based on the conditions that prevailed on the 1st of October. I'm not going into the, that means I know all these things, so I'm just putting up, spinning tails. It should not give that kind of an impression. It is just see. This is the 1st of October. This was the rate on that day, 83.79. The strong recovery from the low of 83.43, that is 23rd, is assuming impulsive qualities with a temporary possibility of stretching to 84.01, 84.14. I'll show how this is arrived at. Puts are near this are expected to hold dips, if any. This is the view. And this is the risk. It must fall below 83.67 to hint that it may find it difficult to rise as expected. Next strong support will be around this level. So I am bullish for the month of October because this is the report for October. We are dealing with the report for October. For October, I am bullish for 84.0114. Now, this is I maintain a manually maintained chart. It's not updated. It's a manually maintained from the data. This is dollar rupee. It is updated on the 1st of October. The upper volatility band shows a downward bend. If I show the actual chart, you will be this is the actual chart, the real chart. There is a green dotted line coming here. This is based on the volatility. This gives beforehand where the price will go. More so when the price consolidates on the sidelines like this, on the sidelines. When it goes to the sidelines, whatever is in the upper, it will be hit. Provided this line should be rising a bit like this. So at that time, the bullishness was, you can see the arrow will display the figure. You can see in small letters, this is September's figure and this is October's figure. It will show 84.15. You must be able to see that number, 84.15. So that is a target. This target I have given for this month. It is kind of tell me in advance what will be their target. So that is the target. I have given 84.01 also as the target, first target. That is previous month's height. When this is crossed, it will have a higher tendency to go and touch 84.15. That is the view for the month. And support, I have given all other things, fortnightly. These are all mostly statistical, linear regression, and then 8-period moving average, exponential moving average, and this is the stop loss. Generally, when something is trending, 20-week is a very safe stop, 83.67. And you see here it is a fortnightly. When I'm talking about stop loss, I'm talking about weekly. That is behind a sound hedging and trading system which says norm is to fix the objective based on big picture and stop loss based on shorter term. So my objective is based on fortnightly chart at 84.15 and my stop is based on weekly chart at 83.67. Now let me go back to the chart again. Okay. This was the chart which I explained in live now. Next, this is a combination. You can see on the left-hand side, dollar index. On the right-hand side, dollar yuan, yuan, CNH. And here it is our dollar rupee. I have taken from Reuters, INR, TRB, all this data from Reuters only, DXY and CNH equals TRB. The blue line, which is going along with the price, is known as Hull moving average, which is one of the best moving averages and of very recent origin. It will tell you, it will give you the approximate direction without knowing any technical analysis. You can, if somebody asks, you can say that this is going down, this is going up, this is going down. Like that, you can say. This one is a statistical study. It is a regression slope. Regression slope is the rate at which the dependent variable moves against the fixed variable, which is time. The price is moving. This price shows that the price is moving like this. Here also it's moving like this. Here also it is moving like this. You can see everywhere the moving average and the linear regression slope, they will be agreeing, they will be in harmony, they will show downside. Here also it's showing downside. Whereas in rupee it's not in harmony because it is a move against the law of nature. This is being held. This is not traded. It is being held. Otherwise, this also should have come down along with this because these two are showing dollar strength. It is yuan strength. When the price comes down, yuan strengthens. Here, euro. Main weight in DXY is euro. So that is how this is the monthly chart. So don't compare this with the daily picture. This is the monthly chart. Both are monthly chart. Then another thing, this is the difference between 10-year Indian bond and 10-year US bond. This is 5-year India minus US. This is 10-year India minus US. You can see there is an inverse correlation. When the difference goes higher, goes lower, this has been making lower low, lower high, lower high, lower low. Similarly, here also. Whereas this has maintained an inverse relationship, inverse correlation very nicely. At this point, it has gone above, it has made a higher high. This hasn't made yet, but you see the advanced direction showing indicators, the linear regression slope and the Hull moving average are pointing upside, and the trend line has been broken. This should bring the price down. That is dollar rupee price down, but it is holding still. So the interest rate differential between IN, so same thing I have mentioned here, it's going to widen in favor of IN, which may strengthen the INR versus USD. Let us go to, we are making an attempt to forecast dollar rupees move in October. For that, this is also another important ingredient, the strength or weakness of DXY. Corrective recovery to 110, 100 is possible before next decline to 99.50 or lower can start. The big picture in DXY is bearish, but now there was a chance for the price to move up to 102.55. Rise above 103.10 may lessen the possibility of this weakening. So I have given other possibilities. So the view is it will go up a little and come down. But this view failed because it went beyond this. You just see. I will show the chart instead of this. No, this is a past chart. Up to 210 only. Live chart I will show. This was taken as a wave 1. This was taken as a wave 1. And you see the Bollinger Band started bending, which means mean reversion. So mean reversion is, this is the number, mean reversion, which is 102.60 something. So it will come down. So I have given 102.55 as the target. What happened is, in reality, it has crossed even above this. It has come close to 103.80 or somewhere there. So this is taken as 1. This is taken as 2. This is going to spend sideways move. It will not be all the way up. It will go sideways before going down. So now the correction has started. Wave 2 has started. This is the picture from, I have been carrying on from for a long time, even from January, I am carrying the same thing, where I have given this as a risk for my bearish shorts. Big picture. So major wave C down in this. The first move is over. Now the correction, you see the 61.8% is 103.85. So if you see the real chart now, this is the real chart. Now, just a few minutes back, ECB cut the rates by 0.25%. The price has started rising. You see 103.85. This is the 61.8% of wave one. It has come close to that. The high for today is 103.66, where it is trading already. So this move, this is what I showed in the slide. The price has fallen and now it is rising as wave 2, A, B, C or A, B. It's a congested move on the sideways direction before it starts going down. For now, it is going up. That is the view on that. Then going to the next slide. This is Brent crude oil. Oh, sorry. For now, I said for now it is going up, which supports the view that dollar rupee also may go up. I have a great correlation between DXY and USD INR. So the point behind describing about DXY's moves is to show that when this goes higher, dollar rupee also has a chance to go higher. It went up to 784.07 and then pulled back, I think. So now chances are brightening up to touch the target which are given at 84.14, 84.15 for the month of October. Now, lastly, coming to the crude oil market. It is Brent crude chart. It's a monthly chart. Yeah, it's monthly chart. It has broken a strong trend line here. The target is around 63 something. It has broken below this, made an attempt to go up, but still it is going down only. It's like this. You see, this is the most important. Amidst the present inflammable geopolitical situation, where just a spark is needed to take price higher past 90s, market is trying to take it below the broken trend line. If you really see what is the problem here, what is the expectation? It's not there are people who are calling $350 $350 dollars per barrel. That is all nonsense. It cannot go to that high. It may go to 90 plus or maybe 100 because Iran produces. See, if the war happens, their oil facilities may be affected. Iran produces about 3% of the world oil, maybe a little fraction more, maybe 3.5 or 3.6 like that. And generally, when a supply is disrupted, like there is a strait called Bab el Mandab. If Bab el Mandab is bombed heavily by Houthis, it allows approximately 500,000 barrels per day. The market reacts by $2. That is, it is not an exact calculation, but by experience, I am telling. If you see approximately 500 million barrels affected in any point, it will jump by about $2. Then, if it continues, it may be there only for some time, and then gradually it will start following the demand-supply fundamentals. Similarly, Iran also has got just maybe 3 million barrels a day. It is 3.6% of the world production. It produces about 3 million barrels a day. It may be around maybe about $10 or $12. That's the maximum it can affect. But there is one danger where it is also anticipated that if Iran is affected, they may disrupt other centers because Iran and Saudi are not friends. Iran and UAE are not friends. They may either directly or through proxies disrupt the oil supply from those centers also, which may lead to levels beyond 100. Otherwise, if only Iran is affected and their weapons are all crippled, then it's going to be just about $10 because of the percentage of uh, supply affected. And they say Hormuz Strait. There are in Saudi Arabia, there are two straits from around Saudi Arabia. One is Hormuz, another is Bab el Mandab. If one of them is blocked, I said it's going to be by $2. If both of them block, it may be about $5 to $7. So whatever way you think, you don't see $300 or so. So it may go up to maybe $90 to $100. That will be bad for rupee. Definitely it will be bad. My annual forecast of 86 may come true if this happens. That is, if Iran is affected and Iran also sabotages the supply of UAE and Saudi, then there is a chance for that to happen. Otherwise, it is left to the market itself. It must be trading around 63. It has. I have been telling several people who used to consult, ask for consultancy. I was giving them, it is a bearish view. It is because of the geopolitical tensions only it is happening like this. Otherwise, it will be trading below 70. That is a strong focus. Once this all this tinderbox situations are eased, then the price may go down because of so many other developments, which I don't want to discuss here because this is about foreign exchange, not about the commodity. Uh, in just as an addition, I am telling, in FX Periscope, there is scope to add more and more commodities also in the future issues. Like you can have copper, and you can have palm oil, or you can have crude oil and natural gas and all such things also. Going to the next slide. The chart of USD INR studied in isolation is bullish. There is no, if it is going down bearish, if it is going nothing like it is bullish. Bullish for 84.15 for the month of October. For the month of November, you asked me on the 30th of October, 31st of October. The chart of DXY studied for taking guidance for USD INR futures part. So far, it has been, I was anticipating maximum 103.85. So it is getting closer to that. For now, dollar is trading around 7 and 83.07. Comparison was made with yield differentials between India and US 10-year and 5-year. This shows that dollar rupee has a scope to come down. This study, as I showed you, DXY also big picture is bearish. USD CNH also big picture is bearish. So dollar rupee also should come down as per the big picture, but not in October, November. Crude oil's bearish tendency amidst a tinderbox situation is noticed, which might help keep USD INR down for a moment, but keep up for the moment, must keep Iran at the back of the mind. Limited upside potential with scope for bullishness to last along with DXY. This is the view. So I have concluded whatever I wanted to say about dollar rupee. It is bullish for 84.15 for the month of October. Sumant, my presentation ends with this.
Thank you so much, Rao sir. I think we can conclude the session tonight. So thank you so much, everyone, for joining us at the FX Periscope October 2024 edition. We hope you found our expert analysis insights informative and valuable. And a very special thanks to our speakers, Mr. Ved Kumar and Mr. Yashwant Rao. So FX Periscope is a monthly report which we launch on the 6th of every month, and can be an extremely useful tool for corporates for risk management and value addition. This webinar that we conduct is just a companion to the actual report, which contains a lot more details, more currencies, more commodities. So you can visit our website at firstbasis.in to register your interest, or you can directly email us at info@firstbasis.in. So I've shared phone numbers and email IDs in the chat box. Thank you so much to everyone. Stay informed, stay ahead, and join us for the next FX Periscope webinar next month to stay updated on market developments. Thank you so much.